Hi all, good evening and welcome. I am Mangesh Deshmukh from Corporate Communication team, and on behalf of CareEdge, I welcome you to our today's discussion on Retail Asset Securitization, Trends and Outlook, and sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Kamlesh Gandhi, Chairman and Managing Director, MAS Financial Services Limited, Mr. Ghanshyam Rawat, Co-founder, President and CFO, Aavas Financiers Limited, Ms. Aparna Mantha, Senior VP and Head Financial Sector Credit, HDFC Bank. This session will be moderated by Mr. Vineet Jain, Senior Director at CareEdge. We will commence this session with the presentation by Jitendra. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries during our panel discussion session. Now may I invite Jitendra to make his presentation.
Thank you, Mangesh. Good evening. We extend a warm welcome to our esteemed guest speakers and all the attendees to this webinar on trends and outlook for retail asset securitization. We have compiled a short presentation and will follow up this with a panel discussion. Please note that the views of the panelists are their individual views and may not necessarily represent the views of the institutions that they may represent. We will start with a short synopsis for today's event. We'll be covering the trends in market volumes, followed by changes made by RBI in the securitization guidelines. We have analyzed market data and have put together an analysis on notch-up and pricing trends for PTCs. We will also touch upon competitive landscape for securitization markets and operational issues with respect to DA transactions. Last few years have witnessed many challenges emerging from the recent conflict in Ukraine, supply chain disruptions, the pandemic, the demonetization, and the GST rollout. The latest is the failure of Silicon Valley Bank, and probably at the root of the failure may be unprecedented rise of interest rate in the US. The fear of contagion effect of the bank failures in the US and the consequent damage to the real economy is a key monitorable as of now. Coming back to the Indian securitization market, the rating performance of PTCs has remained robust throughout. The PTCs appears to be an instrument of choice in a stressed economic conditions given the stellar rating stability. Retail asset pools have exhibited resilient performance throughout the economic cycles. With this backdrop, we will briefly touch upon the market volumes. Continuing the momentum seen in FY22, when the market witnessed a growth of 26% compared to FY21, 9-month FY23 volumes have grown more than 50% from 9-month FY22. DAs continue to command a lion's share of overall volumes, and the DA-PTC split has largely been 60-40 in the favor of DAs during the last few years. Within the DAs, the dominant asset class continues to be mortgage-backed assets, while PTC volumes were mainly driven by ABS pools. Also, the share of unsecured and microfinance pools has been increasing quarter on quarter in the PTC market. The push for the co-lending and its scale-up could have longer-term implication for the securitization market. PSL classification for on-lending and the growth of PSLC market will be an important factor affecting the securitization volumes, especially for PSL-compliant assets. As initially estimated by Care Ratings, the market is expected to grow by 40% in FY23 over the previous year in spite of merger between largest HFC and a bank in India. This is likely to affect the DA volumes going forward. Now we move to the amendment made to the securitization guidelines in December 22 by the RBI. The major change was in respect to restriction on securitization of loans through PTC route with a residual maturity of less than 365 days. This is not applicable for direct assignment transactions. This has impacted the securitization volumes of fintech lenders. Another change was pertaining to MHP. MHP is now counted from the date of full disbursement of the loan or registration of the security interest with CERSAI, whichever is later. Now there is a restriction on securitization of partially disbursed mortgage loans, which was a generally accepted market practice. Next amendment was pertaining to minimum ticket size of 1 crore. Emphasis has been given on single investor exposure, restricting the participation from small investors. Sale of delinquent but non-NPA loans has been permitted to the ARC. Overall, As articulated by the Care Ratings in his article dated 8 December 22, the amendments have not impacted the overall volume of the market significantly. Moving on to some market intelligence that Care Ratings has collected based on the market data, we have tried to look at few things where level of documented work is very limited, if not completely missing. We'll cover the analysis of rating notcher for PTCs and larger pricing trend for PTCs. In the coming slides, we'll first take up the notcher for PTCs. The PTCs normally achieve credit rating higher than that of originator. We will start with making a small but important point that, as is normally spoken, the PTCs are not assigned credit rating, taking the rating of originator as a base. Rather, PTC's rating is an outcome of independent analysis of the specific pool, transaction structure, credit enhancement, etc. The rating, however, also factors the performance risk of servicer also. It is important to note that notch-up terminology is only used as a means of communication or data presentation, rather the way of assigning a rating to PTCs. Indian market has on average seen very limited notch-ups. The value weighted average of notch-up for PTCs is only observed at 1.3 notches. This is primarily due to the higher volumes from AA plus and AAA rated originators, and we will talk about this in details in the next slide. The notch-up has generally been restricted to 4 notches, with a handful of cases where 5 notches have been seen. Rating notch down, though possible, is again very limited in Indian context. The notch-up data presented here are only limited to senior most PTCs for given transactions, and for the purpose of presenting data in the notch-up framework, the base rating assigned to the originator by the same CRA which has rated the PTC is considered. If the CRA rating the PTC does not have a public view on the credit rating of the originator, the credit rating assigned by the Care Ratings has been taken as a base rating. In the case where Care Ratings also doesn't have a public view of the originator, then the lowest public rating of the originator is used as a base rating. For the purpose of analysis, Care Rating has taken transactions that were concluded from October 21 to December 22. In this slide, the Care Ratings has presented the rating of originator on the x-axis and the rating of PTCs on y-axis. The percentage are computed based on value. The way to read this table is AAA rated originators accounted for 17% of the market volumes during the observation period, while the issuance of AAA rated PTCs accounted for 71% of the market volumes. The market data shows that AAA and AA rated originators dominate the PTC market with 70% of market share in servicing. AAA and AA category PTCs accounted for 87% of the market. PTCs with 1 notch up account for 48% in the value terms, while PTCs with 3 and above notches account for 17% in the value terms. PTCs with 5 notch up account for less than 0.25%. And so are the PTCs rating below the rating of originator. PTCs originated by entities that were rated BBB minus or unrated account for little over 0.5% value terms. PTCs originated by entities rated in BBB category and A categories have largely seen around 2.5 and 2.35 notch-up respectively. I hope the participants have found the information presented before useful. We'll now move to the next important complex area, and we expect good inputs from our eminent panelists as it is their area of real-life practice. We are talking about pricing of PTCs here. While it is a bit complex, but we have still tried to put together multiple factors which have been bearing on the pricing decision of PTCs. We understand the real-life situations are dynamic. We have still attempted to identify the factors which could have potential bearing on the pricing decisions. Eventually, it is all about effecting negotiation and the relationship in the Indian context. There are some positive factors and there are some negative factors determining the PTC pricing. Out of the factors identified, some factors will have more pull than other in different situations. Having broadly covered the key factors driving the pricing of PTCs, we'll now present an analysis of observed market data to understand if there are any trends which can be seen. We have organized this data as into 2 different sets to look at the same data set from 2 different angles, one from originator perspective and one from investor perspective. We'll first take up the originator perspective. The data in next few slides largely demonstrate that for originator rated A category or above, PTCs help the originators optimize the overall cost of funds by getting lower interest rate for the PTCs compared to the plain vanilla debt. This is largely driven by PSL premium and or better credit rating for the PTCs. Triple A rated originators are clearly able to get rates lower than AAA benchmark rate for the PTCs placed by them. This is largely driven by the premium for PSL assets. On an average, triple A rated originators have got yields lower than benchmark by 125 basis point. Double A plus originators are also able to get lower than double A plus benchmark in the period after Feb 22 for most of the PTC issuance, and this is largely driven by premium for PSL assets and AAA rating for the PTCs. On average, double A plus rated originators have got yields better than benchmarks by 25 basis point. The observation period prior to March 22 was characterized by relatively low interest rates, which reduce the relative value of PSL assets and negatively impacting the pricing of originator. This period has also seen non-PSL transactions which do not have benefit for the PSL premium in the pricing. The pricing dynamic for AA plus rated originators also holds good for the other AA category originators. For AA minus and AA rated originators, while the number of transactions were lesser, the issuance prior to March 22 were impacted by probably relatively low value of the PSL assets. Moving on, trends similar to AA category can observed in A plus, A and A minus category. A plus rated originators, the pricing improved dramatically post March 2022 with pricing lower than benchmark by 13 basis point pre-March 22 to 83 basis point post-March 22. For A and A minus rated originators, pre-March 22 pricing was higher than benchmark on an average of 39 basis point, which subsequently improved to 66 basis lower than benchmark. The general trend for the triple B categories is slightly different. However, the rates have improved post-Feb 22 and general transactions have been on both the sides of benchmark rate. An interesting point to note will be that absolute rate levels have largely remained similar, implying negligible rate transmission. Another interesting dimension from investor perspective is that the investors can get better yield for a given credit rating. Given the credit rating of PTCs, the range of observed yield is wide and bears decent correlation to the rating of originators. In this slide, we present the data for the observation period of AAA rated PTCs. In the chart, we have given AAA benchmark curve, while the data is presented to AAA rated PTCs placed by entities across the rating scale. We have differentiated the credit rating of the originators by assigning different colors. When we look at a chart, we can see the trend that PTCs rated at same level, which is AAA in this case, gets priced in a band which is very wide, generally 2 to 3%. Investors can invest in AAA PTCs on both the sides of benchmark curve. We have highlighted the rates of AAA, AA, and A category rated originators. The AAA rated originators are able to place PTCs at the lower end of the chart, highlighted in the orange color. These rates are all below the AAA benchmark rates. The AA plus rated originators are able to place the PTCs slightly above the AAA rated originators, largely around the benchmark rate. These are highlighted in the pink colored circle. If you look at A plus rated originators, they are able to place the PTCs above the benchmark rate, highlighted in the green colored circle. The investors are able to get better yields for the PTCs rated at same level as the rating of originator goes down. So for a similar risk on PTCs, the investor is able to get a higher return. It's a win-win situation for both investors and originators. Unlike AAA rated PTCs, which gets priced on both the sides of benchmark rate, PTCs rated in AA category are generally getting priced north of the benchmark rates. So there is a clear advantage to the investors that are able to get a higher yield compared to the benchmark rate. A trend similar to AA category can be observed in PTCs rated in A categories and investors get yield pickup. The trend is no different for a few PTCs rated in triple B category. The market has not seen issuance of senior most PTCs rated below the investment grade except by some unrated entities. Some of the key takeaways from originator perspective is that they're able to achieve cheaper resources compared to their own borrowing. This holds good for the high-rated entities from AAA to A minus category, primarily driven by premium PSL assets and their high-rated PTC from the base rating. It also helps A minus and below rated originators in investor diversification. From investor perspective, there is a yield pickup for given credit risk based on the rating of originators, especially from AA and below rated originators. It helps investor build risk appetite for low rated entities seen from the rating stability of the PTCs, even during extreme situations. This is to clarify the base data is taken from October 21 to December 22. For the rating of the originator, we have taken the care rating as a base, or in the absence of care rating, the lowest public rating available. For the benchmark, we have taken the 3-year NBFC FIMDA convert into monthly equivalent rate. All the coupons are taken based on the senior most PTCs issued in the market. After this heavy dose of data, we have now come to simpler data on the rate transmission. While the rate transmission is a gradual process, still we felt there are certain trends in the data set that we have looked at. The RBI has increased the repo rate by 225 basis point from 4% in September 21 to 6.25 in December 22. CARE ratings observe the rate for PTCs have also sequentially inched up, reflecting the rate cycle. The rate transmission has not been uniform across the rate cycle scale. The rate transmission of PTCs that has been constrained by the demand of PSL assets. CARE ratings also observe that rate transmission has been higher for PTCs rated A category or higher compared to lower rated PTCs. As against the movement of 225 basis point in the repo rates, the median coupon rate have moved for AAA category PTCs by 162 basis point, 105 basis point for A plus rated PTCs, and on an average 27 basis point for BBB category rated PTCs. Market trend also shows that risk premium for the NBFCs has also reduced over the last few years. In the coming slides, we'll be briefly covering the rating resilience of the rated exposures. We are presenting the data related to rated PTCs, including old rated DA deals. This covers all the senior PTCs rated only by CARE since 2010 onwards, covering a decade, which is sufficient to see multiple cycles across different asset classes, including a minimum of 2/3 cycles of home loans, which have a longest tenure. Apart from natural calamities which have occurred during the 12-year period, this period also covers the immediate aftermath of global financial crisis, demonetization, NBFC liquidity crisis, GST rollout, and last but not least, pandemic-induced national and regional lockdowns, supply disruptions, and interest rate hikes. In this sense, this period can be taken as covering economic cycles as well as extreme situations. As can be seen in the presentation, the credit rating assigned to the senior tranches in 98.5% of total rated transactions are at the same rating or higher than initial rating. The ratings in around 0.6% transaction has been withdrawn after the principal and interest have been fully repaid. The balance 0.9% transactions continue to be rated below their initial rating. However, all of these cases are currently rated in the investment grade. This largely reflects the resilience of the PTC in the terms of rating stability, the point that we made earlier. Additionally, while there can be an MTM provision cost, there have been no credit loss on the senior most PTCs rated by the CARE. Given the exemplary performance of securitization transaction till the date, the resilience of the rated retail asset PTCs is expected to continue. On that note, I would like to hand over the reins back to Mangesh. Thank you.
Thank you, Jitendra. Attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Mr. Vineet Jain to take over the session, please. Vineet is the Senior Director at CareEdge Ratings. He is a Chartered Accountant and a Company Secretary. He has 25 years of experience spread over credit ratings, structured finance, debt capital markets, and corporate bankings, including NBFC lending and portfolio buyouts. He was a part of founding team of IDFC Bank and was instrumental in setting NBFC lending business as a part of financial institution group. He has earlier worked with SBI Capital, Axis Bank, etc. Over to you.
Thank you. Good evening to all the participants and panelists. A very warm welcome to all of you. Thank you, Jitendra, for this informative presentation. The presentation has put a specific focus on analyzing the market data to understand rating nurture for PTCs, as well as to understand if there are pricing trends in the PTC market. I hope that all the participants have found this presentation useful, and they will also gain immensely from the experience of our esteemed panelists here. We have 3 panelists today on the webinar, and I would like to thank each one of them for agreeing to be part of this panel discussion. Just to reiterate the participant that the views of the panelists are the individual views and may not necessarily represent the views of the institution that they represent. I would take this opportunity to quickly introduce the panel members, and it's my privilege to speak a couple of lines on each one of them. Our first panelist is Mr. Kamlesh Gandhi. Mr. Gandhi is the founder and CMD of Mass Financial Services Limited. He has over 2 decades of experience. He is instrumental in managing and propelling the growth of mass financials to this level. His in-depth understanding of business, his vision has been key enabler for consistent performance of mass financials. Mr. Gandhi is actively associated with multiple industry bodies in multiple capacities as member, chairman, or even co-chairman. Mr. Gandhi is also managing trustee for Srimati Urmila Ben Chimanlal Gandhi Foundation. The foundation currently contributes toward financial needs in education and healthcare. A very warm welcome to Mr. Kamlesh Gandhi. Our second panelist is Mr. Ghanshyam Rawat. He is co-founder, president, and CFO of Aavas Financiers Limited. He is a finance professional with more than 2.5 decades of experience. His specialties include fundraising both in domestic and international market across categories of investors. He is a very strong strategic planner with high execution capabilities with analytical mindset to optimize the cost, which have positive impact on the profitability of the companies. He holds a bachelor's degree in commerce from Rajasthan University and is a fellow member of the Institute of Chartered Accountants of India. He has previously worked with First Blue Home Finance, Accenture, Deutsche Post Bank, Pan Asia Industries, Indorama Synthetics. A very warm welcome to you, Mr. Rawat. Our third panelist is Ms. Aparna Mantha. Aparna is currently head financial sector credit in HDFC Bank with over 2 decades of experience on both retail and wholesale credit roles. In his current roles, he also had securitization function. Aparna is a career banker with HDFC Bank and has done her PG from Janara Bajaj Institute. A very warm welcome to you, ma'am, as well. A very warm welcome to all the participants once again for taking their time out to attend this webinar. In case participants want to ask any questions on presentation made or otherwise, they are requested to key in their questions in the panel on their screen. Now we will begin with our panel discussion and simultaneously also take the questions that the participants may ask. While we get questions from the panelists, I take liberty to start by requesting comments from Mr. Gandhi on what's their takeaway on the presentation made. Is there anything which has specifically hit, or is there anything that you think is a miss when you look at the presentation? We would be happy to hear your views on the presentation, sir.
No, thank you, Vineet. And I'm happy to be present here and express my views on retail asset securitization trends and outlook. At the outset, structurally, PTC and DA plays a very important role for the originators to expand their business activities and to an extent de-risk what they have originated, and they can work on the niche expertise. And what we have seen is presented very nicely by your team, that in past 10 years, this has worked very nicely, and 10 years is a long period where we have seen a lot of headwinds. And within that period also, if the retail assets performance is so robust, I think we can only conclude that it's a very positive outlook going forward. And with the COVID behind us and presuming the economy to register a stable growth, we consider retail assets growth as inevitable. And that is where PTC and DA transactions will play a very important role for all the originators. And it will evolve over a period of time. And I would like to see more and more participation of lower rated NBFCs in this space. Because they are the ones who are very good at origination from their demographic point of view. And once they get the access to this market, it will be a catalyst to their growth. And at the same time, the ones who want to grow their balance sheet size will get an advantage from such originators without the real risk of the assets that are attached to it, because of the credit enhancements they get. And in DA, I'm sure the lenders or the portfolio buyers will look at the credit history of that total pool and of the institute and all. So I'll be very keen to see the lower rated NBFCs also coming to the market, and they can play an important role not only for themselves but also introduce good retail assets to the ones who really want to build up retail assets.
True, very true. So when we were looking at the data, Mr. Gandhi, we found that there were at least 20-25 transactions which were from the issuers or the originators rated below investment grade, and a few transactions are also from entities which are unrated. And if you look at market volume in terms of number of transactions, right, that's actually dominated by entities which are in triple B or A minus category. So as probably would be, I think approximately, if you look at average deal size for triple rated PTCs, it's around 425 crore. And it's drastically come down the moment we go to, let's say, double A category. It comes to around 70. And moment we look at data for, let's say, A or triple A minus rated entities, it goes down to approximately 35 crore. So there is more participants from lower rated entities, and there is higher number of issuances from those entities. So that trend is clearly visible, and we can't agree more with you on that. And uh, now, thanks, Mr. Gandhi, for your comments on this. And now we'll turn to Mr. Rawat, and he has been the founding member of Aavas Financiers. Mr. Rawat, internationally, if you look at it, MBS is the largest asset class, right? And when we look at it in Indian context, probably we are completely missing the accent when we talk of PTCs backed by home loans. If you look at regulators, they've been trying to push for higher issuances of RMBSs. RBI in 2021 came with specific regulations, with specific better capital treatment for PTCs for RMBS. And we have been hearing that even NSB is trying to push higher volumes on this count. But if we leave aside the direct assignment market, PTC market for home loans has really not picked up, is the way we look at it. So what in your opinion is the principal cause, or what can be done to see higher volumes of PTCs backed by home loans?
Thanks, Vineet. First of all, thank you to CareEdge to invite us on this special topic, which is very close to my heart, this topic. Vineet, I want to take you a little bit back when 2000, let's say 4 or 5, when few start of this PTC transaction was happening in India in MBS. So at that point of time, LIC, one of the, I think, let's say, largest PSU-backed insurance company, they were buying a number of pool of MBS for a home loan, or let's say LAP product basically. This was a start. On that day, assignment was not there in the market. This business was first started through PTC transaction in India basically, when I think one or two IDB trustee, MD chairman at that point of time, and I was fortunate. I done a few number of transactions at that time in India, 2004, 5, 6, a lot of transactions done in India at that point of time. So, but after that, I think certain policies, process, product came, which became more favorable to the assignment mode basically in India. Like it become a PSL requirement of the banks. So they got immediately retail assets when they do assignment basically. If they do, let's say PTC, it goes in the investment book, and then they have to hold till maturity basically. There was not as such enough market is ready, market is available, where if bank want to sell that PTC transaction in the market, and nothing much platform was available in the market basically. So it was becoming almost held till maturity transaction for them. So appetite was not coming from banking sector. So it became a more of a product when banks is getting retail assets, which was a need for them basically. They want to realign that wholesale book between retail book basically, because they were not having that large platform to generate retail assets. They were more of a wholesale lender in that, let's say 2003 to 2008, we see that high growth pace in India. They were more of a wholesale lender in the market basically. Then except few private banks, but more largely PSU banks were more in the wholesale lending basically. Then I think they picked up this is a route is available to balance their asset size, to take assignment, counter as a retail asset in their book, and make a more and more get retail assets basically. So certain product policy become a more favoring to them basically to that. If you see other investor class, mutual fund is not, because it is a 15-year, 20-year end-to-end maturity MBS pool basically. So for them, it's a mismatch between what they collect the money from the public and what the assets they are creating through MBS pool. Basically, it was not happening a good way. Initially, there was certain tranching was happening, but I think then RBI guideline was not so favoring to the tranching of a MBS pool, basically. So that was again cut off for the certain category of investors in that MBS pool. So in past, I think certain rules, product policy came in such a way, those become more favoring to the assignment. More investors are more interested to have the retail asset on the book than the investment book, basically. So I think that has reached up to this level. But of late, National Housing Bank, as a regulator of a housing finance company, I think they made a certain core committee to develop this parallel PTC securitization market. I was, I think, one of the key member of that committee, and I think we are regularly meeting. I think 2 rounds of meeting we already done at NHB, where we are designing product to provide to comfort to the investors in various form. There is a technology partner also there. There is a product especially partner is also on that committee. I think hopefully. We strongly believe this market to be pick up, because internationally this is a very, very big product in the market to fund the MBS or fund the home loan assets, whether HFC or NBFC or banks anyway.
True, very true. So I think there's a question from one Mr. Ravinder Singh. Probably I think Aparna can take that question. It's largely on the drivers for the market. Would it continue to be PSL driven, or how would it be? So, Aparna, if you look at it, PSL assets command a specific premium, and it is largely believed that in the Indian context, the market is largely driven by PSL assets at this point of time. And if you look at last few years, right, the regulator is pushing alternative products in the market, which probably substitute the demand for PTCs. PSLC is a classical example. Last year, the PSLC volume was around 6.8 lakh crores. And this year, till date, probably I think it have already crossed 7 lakh crore, right? Simultaneously, are we also pushing for co-lending as a model? So, essentially, the question is, do you see that on a longer term basis, the market will continue to be dominated by demand for PSL? Or are you seeing that there would be non-PSL market which will also pick up? So what's your take on that?
So let me just address this in 2 parts. One is the demand for securitization and the demand for PSL. Okay, the demand for PSL is not going away. It is going to be there. Every bank which has the PSL requirement will have to tap into multiple sources for PSL. It can't only be one source. So whether you introduce PSLCs, securitization, direct assignments, or even organic lending of PSL, all these sources will be required, because you need a diversified basket of sources for tapping into the PSL mode. Like, for example, the securitization market existed even before PSLCs were introduced. Now PSLCs have taken up a large share, but that doesn't mean that the securitization market volumes are dropping. Maybe temporarily in phases that could happen. Maybe when the guidelines were introduced, the market took some time to adapt to it. When, demon happened or COVID happened, the volumes would have, kind of been a little subdued during those particular quarters. But I think the securitization market is quite resilient. It has been there for many years, and it is going to be there. The demand for non-PSL securitization comes up when the drivers are not necessarily, from an investor perspective, even from an originator perspective, you want to have a diversified borrowing source. It is not just depending on banks, which will take on balance sheet exposures, because all banks would have, their own NBFC ceilings, their own single borrower ceilings within that. And they also want a mode to diversify, because, at different points of time, securitization, assignment, on lending, all of these are required both from an originator and investor point of view. So the point I'm making is PSL, yes, that will continue to be one of the primary drivers for securitization. but also diversification of the borrowing sources for NBFCs and HFCs, and even for the banks, diversification of sources in which they can invest and lend money to NBFCs will be the second important driver for doing securitization.
Okay, thanks. Hope, Ravind, that clarifies your question. Another question which we have received is, what are the top 3 asset classes in securitization? So largely it's vehicle loans, maybe home loan, LAP, and MFI. These are the leading asset classes. In terms of market share, I don't have the numbers of market share offhand. Probably we can share that later. Another question which has come is, what benchmark rate have you taken for comparing the pricing data? So what we have largely taken is, we have taken the FIMDA, 3-year FIMDA. Now 3-year per se, one could debate on the maturity of the asset on the securitization side, but we have largely taken 2-year. 2-year, 3-year doesn't make much of a difference when we are looking at trend analysis. FIMDA typically gives annualized rates, and PTCs are typically placed on a monthly basis, most of the PTCs. So we have probably taken nominal value of the annualized rate, and that's the in terms of number. And wherever we are comparing it with AAA rating, we have taken the AAA benchmark. Wherever we are comparing with, let's say, AA rating, we are comparing with AA benchmark. That's largely the format that you've used. Now I would like to return back to Mr. Gandhi. Mr. Gandhi, you have been operating actively on both sides of the market. You have been both seller and the buyer in the market. And you probably happen to be one of the early movers when it comes to co-lending, much before the regulators came with this terminology of co-lending. Whether we call it by the name of partnership, sourcing, servicing, or risk sharing, whatever model you call it, probably you have started pretty early, and you have rich experience on the ground when it comes to this model per se. So what's your take on evolution of current co-lending model? Do you see it cannibalizing the direct assignment market in general, or do you see that there are clear product preferences or trends when you look at originators? Few originators clearly preferring sourcing, sourcing partners preferring co-lending model, while few completely against it, and they would like to book the loans on their books and then probably go for direct assignment PTC. How they fund is something that's they would decide later. So how would you put it? What's your experience around this, sir?
Just to take you on the fundamentals, I think this co-lending model being recognized is a very good thing to happen to the smaller originators, whereby serving the informal class, which is a huge class in India to be served, and a real driver for our lending businesses. I think people closest to the ground are the strongest. It's not the function of the balance sheet size. And that is where each one brings their respective forte to the table, that the originators brings their expertise of the demographic understanding, and the ones who can carry on their balance sheets with huge balance sheet size can really benefit. So for banks like HDFC, who are adding on one smaller bank every year to their balance sheet, I think for them this can be a very good model, and I'm sure they must be exploring the same. So fundamentally, we think that, and we have been working on this model since more than 10 years, working with smaller NBFCs of the country, and we have found that model to be very interesting and rewarding. And on your question of how it will trade off between co-lending and direct assignment, I think as far as co-lending is concerned, we are yet to settle operationally. There are so many operational hiccups currently, whereby the understanding between the NBFCs and the banks has to converge on many accounts, because it is not as simple as a mathematical conclusion drawn that it is an 80-20 and that translates into that 80-20% rate. Because at the end of the day, we have to take into account the operational costs, the credit losses. So I think from my experience, what I have I'm talking from the liability side point of view, that tying up with various banks on co-lending, we are in active discussions with various banks to see that how we can converge on the ground level realities. On your question of trading off between both the things, I think the prudent idea would be to have a balanced mix between co-lending, direct assignment, and PTC. Because as an originator, you always see that none of the sources are as permanent as you think they should be. And there are so many underlying factors which affects the availability of each source. So from our experience of more than 2 decades, they always strive to strike a balance between all these three. Having said that, we always prioritize in terms of DA, co-lending and PTC as of now. And given the traction what we have in DA, the majority of our portfolio has been absorbed through DA currently. But I would, for one, like to strike the balance between all these three models. And I would like all the originators to strike the balance between the three. That will be the right way to take it forward on a sustainable and a scalable basis.
So largely you are saying that diversify as much as possible in terms of product, and there is a clear urge on part of lower rated entities to get into co-lending model. Is that fair, sir?
Correct. In products, and also they should not only depend on co-lending. They should have an ideal mix of carrying the assets on their book for some time and then downselling it in terms of DA or PTC. That should also form as the part of the liability management, because you cannot only rely on one form of the liability as a prudent practice, and as experienced over the past so many years, that you should not be over dependent on any one source. So it will be ideal mix will really work better for them.
Okay. So there is a question. I will not identify the entity here, but the question largely is that it's an unrated issuer, and they have been accessing the PTC market. The question largely is that if they get themselves rated, can they expect better pricing? So going by the data that we have presented, probably the answer is in affirmative, but I would request Aparna to give her views on this.
See, what happens is entities by themselves, as in when you are a lender and there are multiple lenders looking at a particular originator, it's always better to have an external rating, because that gives some sense of a common platform basis which lenders can, take a decision. All lenders have their individual ways in which they assess the originator, the pool that is being purchased, and rating is a factor into how this works. However, compared to a non-balance sheet exposure, when you look at a pool purchase, the weightage of due diligence on what you are buying is far higher than who you are buying it from, because other than like you had mentioned earlier in the presentation, the service, you don't start with the originator rating. You rate the pool, and one of the factors that goes into it is the servicer, the ability of the servicer to continue to service and collect through the life of the transaction. So other than the fact that, you can have a common benchmark across lenders, you're able to kind of get your, the starting point is easier. I think, in a securitization transaction, the weightage is always on what you're buying rather than, the external rating of the originator.
Okay, thank you. And there is another question from the same gentleman. Would PTC be cheaper than the normal loan transaction, a term loan transaction? Looking at the data, maybe you can leave aside initial few transaction. If you go by the data, probably PTC is cheaper compared to your borrowing cost, right?
Yeah, PTCs, again, if it's PSL, then it's obviously going to be cheaper. If it's non-PSL or the pool is a blend of PSL and non-PSL, then it depends on the tenor and whether, on-balance sheet is comparable with the off-balance sheet profile of what you are buying. So, yes, PSL, the answer is a definite yes. Otherwise, there are other factors that go into pricing.
Okay. So I'll move to Mr. Rawat again. Mr. Rawat, you covered the MBS market. What are the challenges there? So when we look at ABS market, right, PTC market specifically, how ignoring the home loan. So basically, PTC is backed by non-mortgage assets, right? The appetite outside banking system is very, very limited, right? So what do you think is constraining the other alternate investors, let's say mutual funds or insurance companies, to come and be an investor, more so given the rating performance of the PTCs? So how do you look at this? You are on mute, sir. Sir, you are on mute.
Yeah, Vineet. When definitely we see MBS versus ABS. So I'm sharing my practical example. When you go meet with the PTC transactions, banks, institutions, major challenge comes when we do MBS is a tenor basically. That's it. I think one thing comes. Second thing comes pricing front basically, because MBS asset backed is a definitely very finer price asset get created versus ABS basically. ABS obviously assets has a higher yield, low tenor. So there, I think I don't know why the mutual fund industry don't invest in those papers, because those papers average tenor is 3 year, 4 year basically. A long door to door tenor maybe 5 to 6 years, 7 years, but average tenor 3 years, which is a very good product with the, let's say, mutual fund industries basically. I don't think so there should be any challenge. Yeah, off late one thing has been seen, because credit fund is not getting a much corpus from the public. If you see 12 from 15 16 onward, mutual fund industry is getting lesser and lesser fund in the debt side, more and more fund they are getting on the equity side basically, because a certain credit fund has not performed well or given losses to the investors basically, so they're not getting a fund. But fundamentally, product side is become a very good product from them. I think I strongly believe not today, but let's say maybe in couple of quarter of years they will come back and they will see positively ABS product as a securitization basically, because there is a credit enhancement, there is a better rating than the entity rating. Both are much suited to their investment horizon. That's, I think, apart from that, I think don't see, but right now, I think not much interest from them. But I think as we move ahead, their corpus will move ahead. They will definitely come back to invest in this product.
So there is a question from one Mr. Venkatesh. Taking the global market scenarios, usually the originator and services are different entities. Therefore, pools are typically comprised of multi-originator. What is the panelist view on the same, whereby servicing becomes a separate function? So basically, the question is, if there is alternate servicer, right, which is currently largely missing in the Indian context, how does the panelist view it? Probably Aparna or Kamlesh sir can take this.
Maybe Kamlesh, you can answer and then I can answer.
No problem.
See, from the originator's perspective, multi-origination securitization cannot be a problem, should not be a problem. And that really helps the smaller originators to get the economies of scale, and hence they can avail the liquidity what they want. It is more from the perspective of the buyer, that how are they really convinced on a originator securitization with a third party being the administrator, whereby administrating the loans post they are sold are very important part of these transactions. May not form the part of the legal or the enabling documents, but it is a very important requirement for the lenders to have the faith in the originators that they are in a position to service post it is being sold out, maybe in form of a PTC or one form of an assignment. So from the originator's perspective, I think they should welcome this. And once they've established a good track record on a multi-origination and servicing it the way it has been done on the other PTC and DA transaction, where it has been a single originator being involved, I think lenders will gain more confidence. That is what I understand from my point of view.
And from an investor's point of view, I think as long as you are comfortable with who is going to be servicing it and all the operational issues are ironed out before you actually enter into the transaction. So for example, if I know that it's a pool of say 5 originators, one of the 5 is going to, continue servicing. And if something goes wrong, then, number 2, number 3, number 4, and number 5 sequence is decided, in terms of how the servicing and collections will pan out over, in the event of an alternate servicer arrangement. That's fine. But if there is a situation that, I don't even know who the servicer will be, in spite of having 5 originators who are going to be there in a pool, hypothetically, then my valuation will also be on the capability of the potential servicer and collecting agent who is probably a professional in that particular, geography, that particular activity. So my evaluation will also depend on that. If I'm comfortable, then I think it's a good idea. As a concept, we've been, this particular topic has been discussed for many years, and it's probably time we evaluated an alternate servicer arrangement.
True, and fortunately or unfortunately, whatever you call it, in last 5-6 years, we have seen rated pool changing the services, and in most cases, the rating has been in investment grade. So it's not that when the servicer has changed, the rating is cliffed and downgraded to B, C, D levels. So the downgrades are more because of the legal challenges and not because the lack of alternate servicer. The performance did get impacted, but not to the extent to warrant a junk rating on the better rated PTC. So that experience, fortunately, we have, and with development of ecosystem which has been created in last few years, UPI, Aadhaar Pay, etc., things are looking positive from the alternate servicer perspective. Wherever you have cash to be collected by field visits, that will continue to be a challenge. But otherwise, alternate servicer looks to be far more plausible now than maybe 10 years back.
I agree.
There is a question which is basically difference between pricing of originator and investors. Basically, the question is how could be a win-win? How could both sides win when you have investor and originator on opposite sides? How can both win, right, on the pricing? So the way to look at it is when you compare it with the benchmark, the comparison that we have done, when I'm looking at originator's cost of funding, I'm comparing this with originator cost of funding curve, right? So when you compare with that cost of funding for 2 factors come into play. One is rating, which is better than the originator's own rating. Second is the premium for PSL. There are many more factors. These 2 factors taken together ensure that when you compare this with your own cost of funding, right, you are getting better. When you compare with the benchmark rate, you are getting a better rate. When you flip this to the investor side, what you are comparing is that for the benchmark rate, right, are you getting better yield than the benchmark rate or not? And that better yield is probably driven by illiquidity premium, regular cash flows, the usual stuff that you see in the bond market. That largely explains why both sides gets to win. You have anything to add, Mr. Rawat, on this?
No, Vineet, I think it's definitely when we do PTC or an assignment due to PSL nature, due to and again level of where they are sitting basically, because investor is sitting a high rating, good fund with them, their cost of borrowing is lesser, originator cost of borrowing is higher. So obviously, there is a spread, there is a good margin is available to do assignment and securitization level basically. And obviously, always we have seen in last, I think we are doing assignment 2013-14. Always we have seen assignment securitization overall at basket level is cheaper than our own cost of borrowing from other sources. That is definitely there, but it's a matter of time. Sometimes difference is 25 basis points, sometimes difference is 50 basis points. It depends upon negotiation to negotiation also at point of time, basically. But like in earlier question on assignment, then alternate servicing, I think we all as experienced, as the industry got experience, let me say in another way, when liquidity crisis happened in the NBFC, HFC, certain originator assets has been given to independent separate agencies when we found that there are certain governance issues with them basically. So market has tested independent servicing agent is there, which is a not originator, neither is a investor basically, and those assets got collected and delivered to them basically. So by force, I think we have got tested, industry got tested how independent servicer will work basically. So now matter in the time will come, then we will see by choice also, when we will have a separate good class of servicing companies are available who can work independently for the originator and as well as for the investors.
So there's a question, is there any data for HNI or ultra HNI investment in PTCs? There have been some investment in our limited understanding, but I don't think there is any ready-made data available. There is another question for Mr. Gandhi. Since you are an originator of some wholesale lending portfolio, are there any plans to explore securitization of wholesale asset? I think new regulations allow it. So our understanding is that they have already done wholesale pool securitization, and currently the regulation doesn't allow you to securitize loan given to financial entities. If it is a non-financial entities, then can still be securitized. Right, Mr. Gandhi?
True, very true.
Then there is another question, which is basically of late we are seeing that unsecured loans are getting into the market, especially the PTC route. Are there any reasons why bank and businesses are going for high unsecured loans? So, Mr. Gandhi, would you like to take it?
See, there are a variety of unsecured loans being offered, and if I talk about the ones where we operate, is giving working capital loans to smaller enterprises, that is medium, small SME enterprises. And one of the reasons why this is being done currently by entities like us is more availability of data and authentication of the same. Say, for example, I want to lend 15-20 lakh rupees of loan to a small and a medium enterprise based on the banking and the GST data, which I can draw directly from the source, as compared to the earlier data available from balance sheets, which were always dated. And for me to understand their cash flows and other financial conditions was very difficult to judge. That is where it was very difficult to extend such type of unsecured loans. But currently, with availability of GST data, with the help of account aggregators and with the availability of the bank statements, which we can pull out directly on our own, and where we can authenticate the data, the cash flow is pretty predictable and accessible. So in that situation, there are so many lenders who are happy to lend and take a definite risk on that enterprise, ranging from 10 lakhs to 50 lakhs, depending upon their own credit screens. And an enterprise in return gets a working capital loan which they requires. And that is creating a win-win situation for both for the lenders and for the SME enterprise. And obviously, the common underlying thing is that both the lenders and the borrowers should be prudent enough in their decisions of lending and borrowing. Beyond, if they violate that, then they both land up in problems. But currently, the unsecured loans which has been given to this segment is, according to my understanding, the function of the more authentic data available, and the industry and the economy also coming back to normal, and a lot of SME industry registering a very robust growth.
Sir, when we look at the data for triple B rated entities, what we have found that in spite of repo rate increasing by 225 to 50 basis point, the rate for triple B rated entities has moved up maybe by 40-50 basis point, or let's say 20-25 basis point. So what in your understanding is the precise reason for this? Is it that they are commanding a better risk premium now because in last 2-3 years nothing has gone wrong with them and the entities are far more solid? How do you look at it? What's your ground level experience around this?
So the ground level experience is that for such companies, the rates, there are already much of the premium built in before the rate increase. So where there is an sufficient premium already built in the price, then the rate increase cannot be passed on in the same proportion. If there has been no premium built in, or a very marginal premium built in, then there is very, very little room for the lenders to absorb that. So in the triple B entities where we had already charged the premium, there was scope for us to absorb the rate rise and pass it on to them, which they can absorb. Because as a prudent lender, we also need to understand that beyond a point, the borrower cannot absorb the higher rates, and that can result into higher defaults. So this is the primary reason why not much of the rate transmission has happened there, accompanied by the good quality of the portfolio. So everybody looks at the risk-adjusted return phenomenon, and where they also fit into a risk-adjusted return bracket, they will not be charged more. But the majority is that they already been, there is a lot of premium charged in to BBB entities right from the beginning.
Aparna, you have any different take on this, or you largely agree with what Mr. Gandhi said?
I pretty much agree with what Mr. Gandhi is saying.
I think we have run out of time, but there are many questions on one specific issue, which is the IREC norms. So we'll take that and probably then we'll close it unless there are more important questions. So basically, IREC norms now requires day-end stamping of NPAs, right? And what largely we have been hearing is that systems have graduated, people are managing it well. So it would be interesting to get perspective from both sides as to how is data being supplied and how are banks handling it. So probably we can start with Mr. Rawat if that's okay, or maybe Mr. Gandhi, because Mr. Gandhi Rawat both operates on the sales side.
No, Vineet, I think this thing brought, I think, somewhere October, almost now we are 1 year, almost has been passed. So I think each and every entity is fully compliant now, basically. And we even now, some of the, I think, transaction we supply DPD on daily basis also, not only reporting date. With daily basis, systems are, API links are made, where we are able to provide on daily basis. If one bank has taken a 5,000 account, on 5,000 account, we provide DPD on daily basis also to them, basically. Not at daily stamping is happening with us, basically, no doubt. But even daily supplying is also we started with a few transactions, few banks, whoever want to give us on daily basis also. So I think we have, I think, crossed that requirement. I don't think so any institution who want to grow their business, who want to have a good level of corporate governance, who want to have a good lender on the board, I think they are fully compliant to this. Yeah, if somebody is lagging behind, there may be some individual concerns. I don't think so. There is everybody has to fall in the line. If you want to do business in India, he has to be there. He has to be do.
So before we switch to, let's say, Mr. Gandhi, somebody made an interesting point saying that almost all the transactions that we see in India are on M+1 structure, right? So while M+1 structure, you collect this month, you pay next month. So essentially, the sold down portfolio falls due with a lag of 1 month in the books of the buyer, right? So API etc. would certainly help you would integrate the DPD reporting, right? But when you look at from the financial ledger perspective, right, there is an inherent mismatch, right? So how and can it be perfectly managed, and why don't we respect the transaction that collection will happen this month will be passed on next month, and the banking system goes on though. That's the point somebody was making. So what's your take on that, Mr. Rawat?
I think Vineet, gradually what, let's say, NBFC, HFC having a certain, let's say, certain advantage of there being NBFCs, those are gradually going away. Let me be frankly, one by one we are seeing in last 3 years. Now, let's say there is a difference of charges also, how charges we debit and we collect, how charges bank debit and bank collect, basically, and those charges how goes in the DPD format basis. There's a difference still exists. I think RBI has already given a draft on that piece. They will bring a seamless what bank do, what NBFC do. So I don't think so. Another, let's say, 6 months or 1 year, there will not be any difference between how the bank do, how the HSP, NBFC do, basically. Everybody with the same similar structure, basically. So we collect, we know today we have collected, we can give them even next day also to the banks and institutions. There is no harm on that, basically. Because ultimately, this business need to be mutually rewarded for the banks also, for the originator also. If it is one-sided, then obviously it will not grow. any product will not grow basically. So we believe in that. I think we already supplying the daily DPD. We can supply the daily cash flow also. But I don't know. But I think lot of originator give the interest rate benefit till the M1 plus also. It's not, banks are not at a loss at anywhere. Today, if we have collected, if we are paying banks to outflow at M plus 1, so we serve the interest flow M plus 1 till M plus 1 also to them basically. So as far as interest is concerned, banks are not at a loss basically. Yeah, we retain the cash flow for 30 days, so we pay the interest for 30 days also to them basically.
Sure. Mr. Gandhi, your perspective as a seller? Then we'll circle back to you for your views.
I agree with what Mr. Rawat told, that while we are in a position to give the information, the cash can also be given or it can be remitted the way bank intends or the bank desires. But this is more from the operational convenience. All these transactions, at the end of the day, you need to have operational convenience. You are doing multiple transactions and you have to have the multiple dates of installments from the borrowers. As NBFC, we have at least 2 to 3 dates, and in some products, it is 4 dates. So in order to have operational convenience, it has been decided that it will be collected during the whole month and it will be remitted the next month. So as long as there exists confidence between the seller and the buyer, I think this will continue. Or if some buyer insists that no, I want it on a real-time basis, and if the seller is okay with that, that can also be implemented.
No, our take is that largely, I don't think there is any question of confidence between them. The confidence has existed, continues to exist, and that's why the transaction is happening. It's about how the RBI wants to implement it, and is it really feasible? So, Mr. Aparna, your take?
I think this cash flow bit that currently happens on M+1 basis, it's just a matter of time before it smoothens out, because like you said, it's not an interest loss or interest gain for anybody. I mean, you're paying interest, you're using the money for a month. When it comes to IRAC norms or the cash flow part of it, the operational piece has to be ironed out. See, there's no choice about following the guidelines. I mean, the sooner you follow the guidelines, the smoother your execution becomes. When it comes to doing a transaction, prior to that, you have to ensure that your systems are in sync, you're able to provide data on a daily basis. It may take a little bit of time initially before the first transaction happens with the originator, but after that, once you've ironed out that cash flows will come on a real-time basis, or NPA reporting will happen in a like day-end basis where you will be able to get the information, you will be able to do the DPD stamping and all of that. You need iron out that bit before the transaction happens. Then it will obviously be smoother and it will fall in place.
Great. Thank you, Mr. Gandhi, Mr. Rawat, and Aparna for your time, for taking time out for this panel. I hope that the participants have benefited from the presentation and experience of our esteemed panel members. I'll hand it over back to Mangesh for closing.
Thank you, Vineet. Thank you for moderating the session, and again for Jitendra for his presentation. Thank you to all our guest speakers for their insightful views, Mr. Gandhi, Mr. Rawat, Ms. Mantha. It was a privilege to host you, and thank you for all the participants for taking their time out and being a part of CareEdge webinar. For any further queries, feedback or suggestion, please write to us at corp.com@careedge.in. Goodbye for now. I request the tech team to log off.